The global economy is a vast and intricate system, constantly in motion, influencing every aspect of our lives. It operates much like a complex machine, with countless interconnected parts and forces at play. Understanding these underlying dynamics is essential for making sense of our financial world. Among the most fundamental of these economic forces are inflation and deflation. These two concepts represent opposing movements within the economic system, each with profound implications. They describe shifts in the purchasing power of money and the general price level of goods and services. Navigating the financial landscape effectively requires a solid grasp of both inflation and deflation. Their effects can determine the value of our savings, the cost of our daily necessities, and the trajectory of national economies. This understanding is not just for economists, it is crucial for every individual and institution. Inflation is defined as a sustained increase in the general price level of goods and services in an economy over a period of time. It means that, on average, the things we buy, from groceries to housing, are becoming more expensive. This phenomenon is a natural part of modern economies, though its degree varies. Consequently, as prices rise, the purchasing power of money diminishes. A dollar today will buy less than a dollar could buy yesterday. This erosion of value is a core characteristic of inflation, directly impacting how much we can afford with our earnings and savings. One primary mechanism driving inflation is an increase in the money supply. This often occurs through government spending or through policies implemented by central banks. When more money is introduced into the economy, its value per unit tends to decrease. This leads to a situation where more money is chasing the same amount of goods and services. When demand, fueled by readily available cash, outstrips the supply of products, sellers can command higher prices. This is a classic economic principle in action, affecting everything from essential commodities to luxury items. The rising cost of everyday items such as food, fuel, and utilities is a tangible symptom of this process. Consumers experience this directly, seeing their budgets stretched further. The cumulative effect across the economy can be significant and widespread. Another significant driver is known as cost-push inflation. This occurs when the cost of producing goods and services increases, prompting businesses to raise their prices. These rising production costs can stem from various factors, including higher raw material prices or increased wages. When businesses face higher expenses for inputs like energy, labor, or components, they must either absorb these costs or pass them on to consumers. To maintain profitability and remain viable, passing these costs on to the end user through higher prices is a common strategy. This effectively shifts the burden of increased production costs. This dynamic can initiate a vicious cycle of price increases. As the cost of living rises due to higher prices, workers demand higher wages to maintain their purchasing power. These increased wages then become another cost for businesses, potentially leading to further price hikes, perpetuating the inflationary spiral. One of the most insidious consequences of inflation is the erosion of savings. As the purchasing power of money decreases over time, the real value of accumulated wealth declines. Money stored in traditional savings accounts, earning minimal interest, loses its buying capacity. This makes it considerably harder for individuals to plan effectively for their financial future. Goals such as retirement, purchasing a home, or funding education become more challenging to achieve when the value of savings is constantly being diminished. It compels individuals to seek higher returns, often involving greater risk. Inflation can also significantly distort investment decisions for businesses and individuals alike. The uncertainty surrounding future price levels makes long-term financial planning exceedingly difficult. Businesses struggle to predict future costs of materials, labor, and capital. This unpredictability impacts strategic investment. Companies may hesitate to embark on large-scale projects or expand operations if they cannot confidently forecast future returns and expenses. This can stifle economic growth and reduce overall productivity, as capital is allocated less efficiently. For individuals living on fixed incomes, inflation can be particularly devastating. Retirees, pensioners, and those relying on Social Security benefits often experience a severe decline in their standard of living. Their income does not adjust to the rising cost of goods and services. As prices increase for basic necessities like food, housing, and healthcare, the purchasing power of their static income diminishes. This makes affording essential goods and services increasingly difficult. Many find themselves forced to cut back on crucial expenses or dip into their limited savings. Beyond individual financial struggles, high and unpredictable inflation can have broader societal effects. It can exacerbate economic inequality, as those with assets that appreciate with inflation often fare better than those whose wealth is primarily in cash or fixed incomes. This can create a deeper divide within society. Furthermore, persistent high inflation can lead to social unrest and political instability. When large segments of the population feel their economic well-being is under threat and their future is uncertain, dissatisfaction can boil over. This underscores the importance of maintaining stable price levels for overall societal harmony. Deflation is characterized by a sustained decrease in the general price level of goods and services in an economy. In essence, it is the opposite of inflation, where money's purchasing power increases over time. Things generally become cheaper, rather than more expensive. On the surface, this might appear to be a universally beneficial scenario, as money buys more goods and services. Consumers might initially welcome lower prices, anticipating further savings. The immediate perception is often one of increased affordability. However, the reality of prolonged deflation is often far more nuanced and problematic for the overall health of an economy. While a temporary dip in prices can be positive, a sustained period of falling prices signals deeper economic distress. Its consequences can be severe and widespread. Deflation can be triggered by several factors, often indicating underlying economic weakness. One common cause is a decrease in the money supply, which can occur if central banks tighten monetary policy too aggressively, or if lending activity slows significantly. Less money in circulation means each unit becomes more valuable. Another significant trigger is a widespread decline in overall demand for goods and services. When consumers and businesses reduce their spending, either due to uncertainty, high debt levels, or a lack of confidence, companies respond by lowering prices to stimulate sales. This reduced demand then propagates through the economy. For businesses, deflation presents a formidable challenge. Faced with falling prices for their products and services, companies are often forced to reduce their own costs to maintain any semblance of profitability. This leads directly to reduced profit margins, making it difficult to sustain operations. To cut costs, businesses frequently resort to painful measures such as wage reductions, hiring freezes, or most critically, layoffs. This contraction in employment contributes to a weakening labor market. As a result, economic activity slows down dramatically, leading to an overall contraction of the economy. One of the most detrimental effects of deflation on consumer behavior is the wait-and-see mentality it fosters. When consumers expect prices to fall further in the future, they often delay non-essential purchases. Why buy something today when it will be cheaper tomorrow? This rational decision at an individual level has devastating macroeconomic consequences. This widespread delay in consumer spending significantly reduces demand for goods and services. Businesses, already struggling with falling prices, then face even lower sales volumes. This exacerbates the economic downturn, creating a self-reinforcing cycle where falling demand leads to falling prices, which in turn leads to further reduced demand. Deflation also has a severe impact on debt, increasing its real value. While prices and incomes fall, the nominal amount of debt owed remains fixed. This means that borrowers find it progressively harder to repay loans, as their incomes shrink relative to their outstanding obligations. This phenomenon can lead to widespread loan defaults for both individuals and businesses. As defaults rise, banks and financial institutions suffer losses, potentially triggering a financial crisis. The stability of the entire banking system can be jeopardized by this cascade of negative economic effects, including credit tightening and bankruptcies. It is clear that both inflation and deflation can be profoundly harmful to an economy and its citizens. However, their destructive mechanisms and consequences differ significantly. Inflation erodes purchasing power over time, making future planning difficult, while deflation can halt economic activity and cripple debtors. Neither extreme is desirable for sustained economic health. The best scenario, as commonly agreed upon by economists, is often a stable, predictable, and low level of inflation. This offers a balance, stimulating spending without significantly devaluing savings. This desired balance is precisely where central banks play a crucial role. Institutions like the Federal Reserve in the United States or the European Central Bank actively manage monetary policy to achieve specific economic objectives. A key objective is price stability. Central banks typically aim for a target inflation rate, often around 2% per year. This modest rate is generally considered healthy because it provides an incentive for spending and investment without causing excessive erosion of purchasing power. It offers a buffer against deflationary pressures. Maintaining this delicate balance between avoiding runaway inflation and preventing debilitating deflation is an extremely complex act. Central banks utilize various tools, such as adjusting interest rates and engaging in open market operations, to influence the money supply and guide the economy towards this target. The public's surface-level assumptions about inflation and deflation are often misleading. It is tempting to view falling prices as always good and rising prices as always bad. However, as we have explored, the true impact depends on a multitude of complex factors. The velocity of money, consumer confidence, global supply chains, and fiscal policies all interact in intricate ways to shape the ultimate outcome. A slight uptick in prices might be a sign of robust demand, while a prolonged dip could signal deep economic distress. Both forces can have unintended consequences that ripple throughout the economy. The presence and management of inflation and deflation have significant long-term implications. They shape investment decisions, influencing where capital flows and which industries thrive or struggle over decades. This directly impacts job creation, technological innovation, and national competitiveness. Furthermore, these economic forces profoundly influence social structures. They determine the distribution of wealth, the real value of retirement funds, and the affordability of basic necessities for generations. Ultimately, they impact the overall health and stability of the global economy, making them critical subjects of study and policy. The question of which is worse, inflation or deflation, is not a simple one with a straightforward answer. Both present significant challenges to economic well-being and can lead to severe disruption. Each carries its own distinct set of risks and societal costs, impacting different groups in different ways. A hyperinflationary environment can decimate savings and create chaos, while a deflationary spiral can lead to stagnation, unemployment, and financial crises. The optimal economic environment is characterized not by extremes, but by stability and predictability in price levels. This allows for informed planning and fosters confidence. Understanding these powerful economic forces, their causes, and their consequences is paramount in a world of constant change. For policymakers, businesses, and individuals alike, this knowledge is not merely academic. It is an essential tool for navigating the complexities of the modern global economy and striving for a more secure financial future.